Okay, so when does a simple promise you make to a customer turn into, well, a complex accounting headache? That is the question at the heart of Step 2 of the IFRS 15 revenue standard. Today, we're going to break down how to identify your performance obligations, which is really just a fancy way of figuring out exactly what you've promised to deliver.
It sounds so simple, doesn't it? But honestly, the answer to this question is the linchpin for your entire revenue model. If you get it wrong, you could end up recognizing revenue way too early or way too late, and either one can have some pretty serious consequences for your financial statements.
Because this isn't just some academic exercise. Getting this right is absolutely critical. It literally determines the precise timing and the exact amount of revenue you can book from any given contract. So yeah, the stakes are super high.
So, what are we actually looking for when we read a contract? Well, the standard calls this thing a performance obligation. Let's dive in and define what that really means.
Okay, here's the official definition. It's a promise to provide a distinct good or service. Now that word, distinct, that is the most important part of this entire step. You really have to hang on to that word. Think of each distinct promise as a single unit for recognizing your revenue.
And here's a really important thing to remember. A promise isn't just what's buried deep in the legal text. Nope. IFRS 15 forces us to look at the bigger picture. Did your marketing materials create a certain expectation? What about your public policies? Or even just your normal way of doing business? The bottom line is, if the customer reasonably expects it, it counts as a promise. So, a contract could be absolutely full of promises, both written and unwritten, but we don't account for every single one separately. Before a promise gets its own accounting treatment, it has to pass this critical filter. It's known as the distinct test. This is the core principle of Step 2. If a promise can't stand on its own, the standard says you have to bundle it with other promises until you've created a package that is distinct. So how in the world do we figure that out?
Well, here's how we do it. It's a two-part test, and a promise has to pass both parts. First, you have to ask yourself, can the customer actually benefit from this thing on its own? And second, looking at the specific deal, is this promise truly separate from all the other promises? Let's try to make that a bit more concrete.
I know, that still sounds a little abstract. So let's use a simple example to make it crystal clear. Imagine you're selling and installing two very different kinds of machines.
This is that two-part test in action. So look on the left, in scenario A, we've got this complex, specialized machine. Only you can install it, and that installation process actually customizes the machine itself. They are highly interrelated. The customer gets zero benefit from the machine without your unique installation. So what's the result? It's one single performance obligation. Now contrast that with the standard washing machine over in scenario B. Any plumber can install it, right? The machine and the installation are not highly interrelated. The result? You've got two distinct promises, and therefore two separate performance obligations. And this really matters because it means you recognize revenue for the machine now, but the revenue for the installation later. It changes the timing of your income.
That whole machine example really hinges on that second test, being separately identifiable. So what are the red flags we should be looking for? What are the signs that two promises are really just components of one larger promise?
The standard actually gives us three key indicators. You just have to ask yourself, is this item just an input to create some combined final output? Does it significantly modify or customize another item in the contract? And are these promises highly dependent on each other? If you can answer no to these questions, chances are your promise is distinct. All right, now there's one final but important twist to all of this. The standard has a special rule for services that repeat over time, and it can actually simplify things a lot.
The standard uses this pretty technical language to describe it. It's for a series of distinct items that are basically the same and are transferred to the customer in the same way. So, what on earth does that mean in practice?
It's much simpler than it sounds. The perfect example is something like a weekly cleaning service. I mean, think about it. Each individual cleaning visit is distinct, right? The customer clearly gets the benefit of a clean office that week all on its own. But because each service is pretty much the same and has that same pattern of transfer over time, IFRS 15 lets you treat the entire year-long contract as one single performance obligation, and that simplifies the accounting a ton.
So after all that, what is the one thing you absolutely need to remember? Let's distill it all down to the final takeaway.
If there's just one thing you take away from all this, it's the number 2. It all comes down to that two-part test. Number 1, can the customer benefit from the item on its own?
And number 2, is it distinct within the context of this specific contract? That is your guide for every single one of these decisions.
You see, ultimately, this isn't about just following a checklist. It's about applying professional judgment. And mastering that judgment for step 2 is what truly builds a solid, defensible foundation for all of your revenue accounting.
And this leaves us with a big final question, right? The line between our two machine examples, between one promise and two, it's often a judgment call. How much customization counts as significant? How dependent is highly dependent? Well, that's where the rules end, and the real art of applying IFRS 15 begins.